every year. The world is changing dramatically, and so has the financial landscape. The stock market, once a symbol of boundless optimism, now feels like a ship navigating a stormy sea. The waves of uncertainty are higher than ever. Investors are facing a trifecta of challenges: high interest rates, inflated stock prices, and rampant speculation. These issues are causing sleepless nights for many. These factors have created a sense of uncertainty, leaving many wondering where to turn for safe and profitable investments. The search for stability is more crucial than ever. Navigating this turbulent market requires a steady hand and a clear strategy. It's not just about surviving but thriving amidst the chaos. We can look to legendary investor Warren Buffett for guidance. His wisdom is a beacon in these stormy times. Buffett, known for his long-term approach and value investing philosophy, offers valuable insights into how to weather the current storm. His principles remain relevant. This is not the first time the market has faced such challenges. History is filled with similar periods of turmoil. History has taught us that periods of high speculation and overvaluation are often followed by corrections. These corrections, though painful, are necessary. This is a natural part of the economic cycle. Just as seasons change, so do market conditions. Understanding this cycle and learning from the past is essential for investors in 2025. By studying history, we can better prepare for the future. One of the most significant challenges facing investors in 2025 is the rise of interest rates. After a prolonged period of historically low rates, the Federal Reserve has been steadily increasing borrowing costs to combat inflation. This has had a ripple effect across the economy, impacting both businesses and investors. For businesses, higher interest rates mean increased costs for loans and financing. This can put a strain on profitability, particularly for companies with high debt levels. In some cases, it may even lead to a decrease in investment and hiring. Consumers are also feeling the pinch, as higher rates translate into more expensive mortgages, car loans, and credit card debt. This environment of rising interest rates has made it more challenging for companies to grow and generate profits. Investors need to be selective, focusing on companies with strong balance sheets and the ability to navigate a high interest rate environment. In times of market uncertainty, Warren Buffett has often turned to a safe and reliable investment: U.S. Treasury bonds. These government-backed securities are considered a low-risk investment, offering a steady stream of income in the form of interest payments. As interest rates have risen, so too have the yields on Treasury bonds, making them an increasingly attractive option for investors seeking stability. Buffett's recent moves reflect this sentiment. Berkshire Hathaway, Buffett's investment conglomerate, has been increasing its holdings of Treasury bonds. In his 2024 annual letter to shareholders, Buffett highlighted the attractiveness of short-term Treasury bills, noting that they offer extraordinary yields compared to other investments. This shift towards bonds is a significant signal from one of the world's most successful investors. It suggests that even amidst market volatility, there are still opportunities to find value in more conservative investments. While interest rates have been climbing, so too have the valuations of many companies in the stock market, particularly in the technology sector. Years of low interest rates and easy money fueled a surge in tech stocks, pushing valuations to lofty heights. However, as interest rates rise and economic growth slows, concerns about overvaluation have come to the forefront. Many tech companies, particularly those in the high-growth unprofitable category, are trading at price-to-earnings ratios that far exceed historical norms. This suggests that their stock prices may be inflated and not supported by their underlying fundamentals. As interest rates rise and investors become more discerning, these high-flying tech stocks may be vulnerable to a correction. This is not to say that all tech companies are overvalued. There are still many strong and innovative companies in the sector. However, investors need to be selective and avoid getting caught up in the hype. Section 5: Cash is King. Buffett's strategy for a volatile market. In the face of market uncertainty and high valuations, Warren Buffett has been building up his cash reserves. Berkshire Hathaway is sitting on a massive pile of cash, exceeding $140 billion. This cash position gives Buffett enormous flexibility to make strategic investments when opportunities arise or to weather any potential market downturns. Holding cash may seem like a passive strategy, but in the current environment it's a sign of discipline and patience. By avoiding overvalued assets and maintaining a strong cash position, Buffett is positioning himself to capitalize on any market dislocations or to acquire undervalued companies during a downturn. Buffett's cash hoard serves as a reminder that sometimes the best investment is to wait for the right opportunity. In a market where many assets are potentially overvalued, patience can be the most rewarding strategy. Section 6. Riding the wave: speculation and short-term opportunities. While Warren Buffett is known for his long-term investment horizon, the market in 2025 is also characterized by a surge in short-term speculation. The rise of retail trading platforms and the increasing popularity of options trading have made it easier than ever for individuals to make leveraged bets on the market. This increase in speculation has created opportunities for short-term traders who are able to capitalize on market volatility. However, it's important to remember that short-term trading is inherently risky and requires a different skill set than long-term investing. While there may be money to be made in short-term trading, it's essential to approach it with caution and to be aware of the risks involved. Section 7. Patience is a virtue. Learning from Buffett's long game. One of the most important lessons investors can learn from Warren Buffett is the value of patience. Buffett's investment philosophy is built on the idea that good things come to those who wait. He doesn't rush into decisions or get swayed by market trends. Buffett is a long-term investor who focuses on identifying undervalued companies with strong fundamentals and holding them for years, if not decades. This strategy allows him to ride out market volatility and benefit from the compounding growth of his investments. This patient approach has been a key factor in his success. Just like a tree takes time to grow, so do investments. The rewards of patience are often not immediate, but they are substantial. In the current market environment, with its high valuations and speculative fervor, it's more important than ever for investors to maintain a long-term perspective. The market can be unpredictable and short-term gains can be fleeting. Don't get caught up in the hype or feel pressured to chase short-term gains. These can often lead to poor decision-making and significant losses. Instead, focus on identifying companies with solid business models, strong management teams, and a clear path to profitability. These are the companies that can provide stability and growth over time, and a history of profitability. Look for businesses that have consistently performed well, even during economic downturns. These are the companies that are most likely to weather the storm and deliver sustainable returns over the long haul. Their resilience can be a cornerstone of your investment strategy. Remember that investing is a marathon, not a sprint. It requires endurance, discipline, and a clear vision of your financial goals. By staying focused on your long-term goals and avoiding impulsive decisions, you can increase your chances of success in the market. Patience, after all, is not just a virtue, it's a proven strategy for building wealth. Section 8. Staying grounded in reality. Avoiding the hype and focusing on value. In a market driven by speculation and hype, it's easy to get swept up in the excitement and make emotional investment decisions. The allure of quick profits can be tempting, but it often leads to rash choices that don't pay off in the long run. However, as Warren Buffett has often said, be fearful when others are greedy, and greedy when others are fearful. This wisdom reminds us to stay cautious and not follow the crowd blindly. When everyone is rushing to buy the latest hot stock, it's essential to take a step back and ask yourself whether the price is justified by the underlying fundamentals. Are the company's earnings, growth potential, and market position strong enough to support its valuation? Instead of chasing after the next big thing, focus on finding undervalued companies with strong fundamentals and a track record of success. These companies often fly under the radar, but offer significant potential for growth. Look for companies with a competitive advantage, a solid management team, and a history of generating profits. These attributes are indicators of a company's ability to sustain its performance over time. These are the companies that are most likely to deliver long-term value to investors. By focusing on these factors, you can make more informed and rational investment decisions. Remember that investing is not a game of speculation or gambling. It's a disciplined approach to building wealth over time. It's about owning a piece of a business and participating in its long-term success. By staying grounded and focusing on value, you can navigate the market with confidence and achieve your financial goals. Section 9. Investing with Wisdom. A measured approach for 2025 and beyond. The year 2025 presents a unique set of challenges for investors. High interest rates, overvalued markets, and rampant speculation have created an environment of uncertainty and volatility. However, by heeding the lessons of Warren Buffett, investors can navigate these challenges and position themselves for long-term success. Focus on investing in quality companies with strong fundamentals and a track record of profitability. Be patient and avoid the temptation to chase short-term gains or get caught up in market hype. Remember that investing is a marathon, not a sprint. By staying disciplined, patient, and focused on value, you can weather the storm and achieve your financial goals. The market may be unpredictable, but by following these principles, you can invest with wisdom and confidence, securing your financial future in 2025 and beyond.